So in this video, I want to talk about how you can get a dividend paid to you by holding the stock for just one day with very little risk. There is some risk, but it's not that much. So I'll give you an example with a stock that I purchased yesterday. So I use any website. I just Google X dividend dates this week. And right now I'm using this website called MarketBeat. And I saw that American Express had a dividend. X dividend date was April 2nd. Okay, and it pays 43 cents. And the yearly yield is 1.75. So American Express is obviously one of the big name companies, so I feel safe buying the stock. Now, since X dividend date is April 2nd, that means I have to buy the stock April 1st. And then for me to get the dividend, as long as I buy the stock April 1st or before X dividend date, which is April 2nd, as long as I buy it before April 2nd, then I'll be eligible for the dividend. So basically, I just go to MarketBeat and I just choose market caps over 10 billion just to stay with safer stocks and obviously not pick things with crazy yields. And so here's what I did yesterday. So obviously, there's a risk that when you buy a stock on before X dividend date, the next day the stock usually drops by the amount of that dividend. So if, for example, if American Express is trading at $79 and we know that it's paying a 43-cent dividend, usually the next day the stock will be trading at 79 minus 43 cents. That's usually, in theory, that's what happens. But in practice, sometimes it's different. Sometimes it drops a bit more. Sometimes it actually goes up. So it's really different. But in theory, the market opens 43 cents lower the next day, taking into account that the dividend isn't included in the purchase price of the stock on that day. Only the ones who bought it before X dividend date, so before April 2nd, will get the dividend. So knowing that the stock could drop right after buying the stock before X dividend date, so knowing that the stock could drop on X dividend date, here's the strategy that I'm trying to implement to avoid that risk. So especially right now, it seems to work because VIX is so high, so volatility is so high, so option premiums are so high. So what I did is I bought American Express yesterday at $79, but then I sold a covered call at a 77 strike, expiring April 3rd, so expiring the same week. So today we're April 2nd, so this covered call expires tomorrow. I collected $3.49. Okay, so that brings my cost, down to, if I'll show it over here how much I paid $75.60 while American Express was trading at 79. Okay, so that's a pretty good discount. So my net cost is $75.60. So I only get in trouble or I start losing money if American Express is trading below $75.60 come Friday, April 3rd. Now, right now, since I still own the stock and it's April 2nd, that means I will get the dividend. So my real net cost is actually $75.60 minus the 43 cents of dividend that I'll be getting. So my cost is 75.20, for example. Now, what am I going to do with this stock? I don't plan on holding it. I'll try to get out of it today, April 2nd. But of course, knowing that my cost is 75.6, I need to get out of it higher than 75.6. Sometimes you can close a covered call trade earlier because the call option decays. So if the stock goes up, the extrinsic value of the call option decays, especially that there's one day left in the expiration. So if American Express stays up, I have a good chance of getting out of the trade today, even if I want to, and for very little risk. Might even make a profit getting out of this trade. But if my intention was just to capture the dividend in one day, as long as I'm a holder of the stock today, I will capture the dividend. But of course, I don't want to get out of the trade with a loss. So as long as I'm able to sell the stock today, or the combination of the stock and option, because it's a covered call trade. So I have a short call and I have 100 shares of the stock. So to get out of the trade, I need to close both positions. So as long as I can close both positions higher than 75.6 today, then I will have captured the dividend with almost little risk. Now, the idea behind this is that I'm giving myself room to the downside. I'm basically saying that American Express can drop all the way down to 75.6 while it was trading at 79. So that's like almost 4 points away. American Express can drop all that. American Express can drop to 75.6 and I would still be safe. I would still be able to capture the dividend without risking or losing money on the actual position. Now, obviously, getting a dividend in just one day has tax implications. It's not going to be considered an eligible dividend. So you're not gonna be taxed like a normal dividend is taxed. You're gonna be taxed as regular income. So tax-wise, it's not a good thing, but I just wanted to test it out to see if there's a way to just go in 1 week or even a few days just to collect the dividend and get out, but obviously without risking or without losing money on the actual stock, because usually a stock will go down right after dividends. So I'm giving myself some protection by selling a call option against the position, and even selling an in-the-money call option. So when I bought American Express at 79, I sold the 77 call option, so I even went lower. I didn't sell the 79 call option. I sold the 77 call option, giving myself more downside protection. But it also means that I don't care if my shares get called away on expiration, but I might not even hold it to expiration. So actually, if I hold it till expiration, I will make a profit actually of 77 minus what I paid for it. I paid 75.6. So I could actually make a profit of $1.40 plus the 43 cents of dividend if I hold this till expiration. But I'm not sure I want to hold it till expiration because we're in a very volatile market. I mean, we could drop even more and even harder. So I'd go below my cost of 75.6. So I'd rather my intention was just to get the dividend. So I'll try to get out today if possible, as long as I can get out above 75.6. And today, actually, you could see here on this website. Now, I had the chance to do it with other stocks like Bristol Myers, Cisco, and Western Digital, but the premiums on these stocks did not allow me to go far enough, or didn't give me that much downside protection. I felt like I was only like maybe $1 away from the current market price. So to me, I didn't feel comfortable. I felt like it wasn't enough downside protection in case the stock drops after dividends. So I didn't go for them, but that could have been other opportunities. And I know when VIX is not high, this might not necessarily work because the call premiums might not be that expensive. But today, April 3rd, there's an ex-dividend date on April 3rd for JP Morgan. So that means if I want to get the dividend on JP Morgan, which is 90 cents, I have to buy it today, April 2nd. I'm going to wait till the last 30 minutes of the day. And here's what I'm going to do. I'm going to look up JP Morgan, and I'm going to see right now, yesterday it closed at 84.36. Pre-market is trading at 85.48, but I'm going to wait till the last 30 minutes of the day, and I'm going to do a covered call trade on it. See, right now, covered calls are not showing, but if you look at the last traded call option premiums for JP Morgan yesterday, so if it's trading at 84.36, I'm going to try to go lower. So 84, I'd get $2.28, so it's giving me an extra $2 of protection. If I go to 82, if I go to an 82 strike, I will collect $3.50. So that means, so when JP Morgan is trading at 84.36, I could collect $3.50. So my cost will be 80.86. So I could buy JP Morgan at 80.86 while it's trading at 84.36. But my max selling price will be $82. So I can get an extra $1.15 out of this. But my goal is to get the dividend, the 90-cent dividend, with little risk. So I'm giving myself some downside protection in case the stock drops, just to try to capture the dividend. So that could be, I'm going to try this strategy today. And for example, I could go to 81 to give myself even more downside protection. So if the stock's trading at 84.36 minus a call premium that I'll collect, so I'm reducing my cost, I'm down to 80.5. So my net cost would be 80.5, but my max selling price is 81. So I could make a profit on the difference here between 81 and 80.56, and also capture the dividend of 90 cents. So I'm giving myself downside protection. Now, there is a risk with this, is that usually when you sell in the money, when your call is in the money before ex-dividend date, usually there's a chance that it gets called away. So that means you won't even capture the dividend and your shares will get called away at the strike price. So there has to be room between the strike that you choose and your net cost. So in the example of American Express, my net cost is 75.6 and the strike is 77. So even if my shares get called away before ex-dividend date. So that means I don't capture the dividend. But even if it gets called away, I just make a quick profit of $1.40 in one day just because my stock got called away. So I just make sure that there's always a difference between my strike and my net cost, that there's still room for profit in case the shares get called away on ex-dividend date, because the short call is in the money, so it has a good chance of getting called away. A good way of finding out if you have a good chance of getting called away is usually the corresponding put of the strike that you sold the call option at has to be lower than the dividend being paid out. So for example, if I go for an 82 strike on JP Morgan and I sell a call option at that price at 82, now JP Morgan has a dividend of 90 cents. So if the corresponding put, which is right over here, $1.59, if it's lower than 90 cents, then there's a good chance that my call gets called away, my shares get called away, and I don't get the dividend, but at least I get the profit between the strike and my net cost. So in this case, as you can see, $1.59 is higher than 90 cents. So even at an 82 strike, if I sell a call option at an 82 strike, there's a good chance that I keep the shares, I don't get called away, and I get to capture the dividend the next day. But this price here is after hours. When the market opens, it might be at a different price. But that's how you would know if there's a good chance of getting called away, your shares, if the corresponding put of the strike on which you sold the call option at, if that corresponding put is lower than the dividend amount, then you have a good chance of getting called away. So this is definitely not dividend investing. I guess this is more of a trade. You're basically taking advantage of the dividend payment without really investing in the company, without really caring about the company or researching the company. But you're sort of giving yourself a bit of downside protection, knowing that the stock will drop the next day, by taking advantage of call options that you can sell against your stock. But of course, in order to do that, you need to buy 100 shares of the underlying stock. So it only works with 100 shares because you have to buy, in order to sell a call option, you need to have at least 100 shares. So as you can see, this position, according to the P&L, it's at a loss right now because I'm losing $125 on the underlying stock, but I'm making $51 profit on the call option. But this is yesterday. Today, when it opens, it'll be a different story. So as long as I'm making a profit on these two trades here, on the combination of these trades, then I can close the trade and expect the dividend to come in whenever it's payable. Let's just see when is it payable. So this will be confirmed on May 8th. On May 8th, I can confirm if I got the dividend or not. And then this is an interesting strategy if you just want to capture the dividend for a day by giving yourself a bit of downside protection. Now, I'm just trying it out. I don't think it's really recommended because anything can happen. I mean, the stock can still drop past your protection here of the call premium. But I mean, if you do it at the last 30 minutes of the day and sell it the next day, the probabilities are small, right? That it's going to drop way more than the dividend amount plus more than the call premium. It could happen, but it's less likely. And especially if you stick to quality stocks, it's also even more or less likely. You should also take into consideration that depending on your broker, there's assignment fees. So for example, if my shares get called away at 77, with Questrade, there's a $25 fee. So I have to give room for that $25. So right now, even if I have to pay the $25, I still make $1.40 minus 25. I'm left with $1.15. So you have to pick a strike where there's still profit in case you get called away, but also take into consideration the fees and commissions of your broker. So just wanted to share this with you. So if you have any questions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.